Not following allowance, following allowance. At the time of sale, this is the 2020 financial year. At the time of sale, the entry is debit accounts receivable, credit sales, credit sales. Same entry here at the time of sale, debit accounts receivable, credit sales. In the same financial year 2020, there is no allowance method, so no entry for creating allowance for bad debt. When creating allowance for bad debts, debit income statement with bad debts, you can write allowance. Credit the allowance for credit loss account. So this is contra asset account. This is decrease in revenue or expenditure, recognized as expenditure, increase in expenditure. So the treatment after these both the transactions in 2020 balance sheet. So in income statement, we will record the revenue 100,000, say for example. And then the balance sheet, we will record under the asset, current asset, accounts receivable, 100,000 will be recorded. But whereas here in income statement, revenue is 100,000, revenue or sales. And here, bad debts loss, that is 3,000. Income statement. And here balance sheet will record under the asset, current asset, accounts receivable, 100,000 less allowance for credit loss, 3,000, 97,000 in the balance sheet. So this effect is here. So this is good thing. Following generally accepted accounting principle, the principle is matching principle. Now in 2021 May, what happened? Bad debts arise. Or let us see in 2020 itself, before 31st March, bad debt arise. So the extension here, the same financial year. When bad debts arise, here the entry is debit accounts receivable, bad debts and credit accounts receivable. Say for example, 2,000 arise. 2,000. This is when allowance is not there. When allowance is not there, for actual bad debts written off, we will pass the entry. When actual bad debts written off, we will pass the entry debit bad debts and credit account receivable. But when allowance is there, when allowance method is there, when allowance we created, the entry we passed income statement account data to allowance for credit losses. It is there. This is the thing. So already we debited the income statement. So when after creating provision, when actual bad debt arise, we won't debit again income statement. That is doubling, double effect of accounting. So we won't touch the income statement at all. So then what we will do, there is a permanent decrease in the accounts receivable. That's why accounts receivable should be debited. So here debit, permanent decrease of accounts receivable account data. Sorry. Decrease in accounts receivable means it is credit. Permanent decrease in accounts receivable. Then what should be the debit? The allowance what we created in the past, this allowance, now we are using this allowance. We are cancelling that allowance. Now this actual bad debts has taken the position. So what we are going to do here is debit allowance for credit losses will be debited. So what will be the effect on the balance sheet? Let us see what will be the effect on balance sheet. Here, when we prepare the balance sheet, income statement effect is there here. Income statement, bad debts, this is actual. So that is 2,000. And accounts receivable showing 100,000 and less bad debts written off 2,000, and it will show 98,000. Well, what will be the effect on this allowance method? How it will be treated? Income statement, it doesn't affect actual bad debts written off. However, the accounts receivable are showing 100,000, and from this, what we will do, there is actual bad debts written off 2,000 will be deducted, and this is 98,000. And the provision we already created, which was through 3,000. So now it is out of 3,000, we cancelled the provision 2,000 we have used, and the remaining provision still there. So that is allowance for credit loss 1,000. So it will be 97,000. So there is no effect as such. Here also 97,000. Here also it is 97,000. But the thing is that what here actual bad debts minus 2,000 we will be doing, and allowance for credit losses was 3 minus 2, so 1,000 only will be deducting from account. Now in contra asset account we have only, when you see the accounts allowance for credit losses, when we created it was 3,000. When actual bad debt arise, so this is bad debts written off 2,000. So the balance here is 1,000. So this contra asset again will be deducting 1,000 from here. It will be 97,000. That is the beauty of the allowance method. Say for example, this is not happened in 2020. This has happened in 2021. In 2021, we are showing bad debts 2,000, but actually this is the expenditure of 2020. Mismatching of accounting principle. And we are deducting here 98,000. 98,000. This is not accurate calculation of income and expenditure. But whereas you already, even though there is no bad debt, you already debited this amount in income statement with 3,000. So the revenue and relevant expenditure is matches here. That's why this is generally accepted accounting principle accepts this method. And in the year 2021, there is no effect on income statement. Why? Because already 2020 expenditure is created, and that's all for that. Now what happened here? In the accounts receivable, previously we written off 3,000, that is allowance for credit losses. Now the actual bad debts we are minusing, and from 98,000, 1,000 allowance still is there, and that we are going to contra asset account that we are deducting. So is there any effect on the income statement, and is there any effect on the balance sheet because of this transaction? Same 97,000. Income statement is already 3,000 created. There is no need to create account actual bad debt. So this is the beauty of allowance method. There is no fluctuation because of the actual bad debt. This point is clear to everyone. If you have any doubt, ask.